say, we are assessing JCPenney's profitability, but I told you that I prefer to call these ratios as focusing on the cost factor. Okay, is JCPenney cost efficient? Are they overpaying their labor? Are they overpaying their managers? Okay, are they paying more rent, on some of the properties than they need to? Are they overpaying for the dresses that they buy from all over the globe? So cost efficient, and we constructed those. Let me at this time open. I think we were left with just two of these numbers, two of these measures, PE ratio and market to BIC ratio. And let me open the Excel sheet now so that you can take a look at it. Okay, so we'll come back and review one last time, the overall JCPenney's performance. So this is where we are, price to earnings ratio. So we constructed this ratio. This, I must have told you, I remember, I won't be giving you these ratios because the name itself, is the formula. Price means price per share. Earnings means earnings per share. So that's the formula. So price is given, on the board, for example, it'll be given to you on the test. And earnings per share is, but the formula is earnings per share. You take net income, divide by total number of shares outstanding. That's earnings per share. Here, EPS. Earnings per share, EPS, same thing. So what is this PE ratio? So let me, must have told you that these two, row 25, row 26, these are not profitability measures. We would rather call them valuation measures. This is how we value, JCPenney's. These are some of the ways we value companies. Okay, so let me show it to you here what it means. I'll deal with hypothetical numbers just to keep things simple, help you understand, and then we'll use real numbers and say what these real numbers. Okay, so let's assume hypothetical numbers. Let's say I'm talking about Walmart. WMT is Walmart's, ticker symbol as we call it. Okay, let's assume Walmart's stock price is 100. Okay, and earnings per share (EPS) is $10 per share. So given to you. Even if it's not given, you can calculate this. Take total net income, divide by number of shares outstanding. So the two are given to you. Okay, so the PE ratio, so P, this number divided by this number. So P for price, E for earnings per share, okay? So this gives me 100 over 10, which gives me 10. Of course, this is not real. We'll see the real numbers. So what is this 10? All right, what this 10 tells you is this. When Walmart reports $1, so 1 for, because, 100 divided by 10 gives you 10, so you can put 1 under. So when Walmart reports $1 in earnings per share, investors, you and I, who are buying, selling Walmart shares, are willing to pay a price of $10 for that $1 of earnings. So what we are saying is that investors, you and I, okay, we are pricing Walmart's $1 of earnings 10 times. So if Walmart reports $1 in earnings, okay, per share, we will pay $10 in price. If earnings is gonna be $2, we'll pay $20. So multiply by 10. You see what I'm saying here? If earnings per share is gonna be 3, price will be 30. All right? If earnings per share is gonna be 4, the price will be 40. Okay. Why 10? You might be wondering why this 10, the PE ratio of 10. Let me flip this. Let's flip this PE, E over P. E over P. So I want you to think. Sometimes, we professors over-talk, over-explain, We feel like you are not listening, so we have to say the same thing twice, 3 times. What do you think? What is this E over P? This is 10%. Think about this. You may want to think about, similar questions on the test. If you are stuck somewhere, think. What's going on? E over P. Who will tell me what is the 10? I'm trying to tell you how the market, could be behaving by valuing Walmart in this fashion. What do you think E over P is? Yes? 10%, this gives you 10%. I just flipped this, so this is 10, that's 10%. So,
it's the rate of return?
yes, you can say it's the rate of return. So it says that when you pay $1 in price, when you pay $1, in price, you get a 10 cent as your rate of return. So the market by pricing, is telling you what rate of return they want. You see what I'm saying here? The market, when the market, you and I, when we trade Walmart shares, okay, we are telling Walmart, hey, this is the rate that we want. For example, the price, who determines the price? You and I do, $100. You and I, when we buy and sell, okay? Suppose the price goes to $200 or 50. Let's say the price goes to 50. So let me rewrite the same thing. So by lowering the price now, what signal are we telling Walmart? So what's the answer first of all? This is going to be 20%. So what signal are we sending to Walmart by lowering the price? You and I, by trading, nobody's willing to pay more than $50 for one share of Walmart. Now investors are saying, we wanted 20% rate of return. Does it make sense? Why would you want a 20% rate of return instead of 10% rate of return? Why? Why would investors all of a sudden jack up the rate of return they require? For what reason?
The risk.
Risk. Okay? GE stock, it was at $30 a couple years back. It went as low as $6, $7. Why is JCPenney stock at $1? Why is it at $1? Because investors see a greater risk. Okay, they see a greater risk. So they are requiring maybe a 30% or 50% rate of return. And believe me, yes, if JCPenney is able to turn around, if it's a successful turnaround, you may be able to double your money. Yes, the stock can quickly go from $1 to $2. You see what I'm saying here? 100% rate of return within a span of a few months, yes. If the new CEO is able to turn around JCPenney. But if it doesn't, what's the flip side? You lose everything. You lose everything. Okay, so this is what the PE ratio does. The PE ratio, if you flip it, you understand what's going on. If you flip it, it tells you the rate that shareholders, investors right now require. So when the PE ratio is 10, so what does it mean? If tomorrow Walmart reports earnings per share of $20, who will tell me what the new stock price will be? If Walmart reports earnings per share of $20, what do you think the price will be? Remember, the PE ratio is 10. So if the earnings per share is 1, the price will be 10. If earnings per share is 2, the price will be 20. If earnings per share is 3, the price will be 30. So if earnings per share is 20, the price will be how much? 200. Just multiplied by 10. All right? So it's a valuation measure that investors use. So this is called the PE ratio. Okay, so I want to show you, the real PE ratio so that you can understand it better. So I'm going to this.